As always, the banks are in trouble. And when you see the amount of losses that they're taking on as a result of monetary manipulation, you know that there's a need for liquidity. And based upon history, when the central bank began injecting liquidity, that's a sign that something is broken. And as of right now, they just put more funny currency in the system. And because of all that, that is a clear indication that the banksters are panicking behind the scene. And therefore, gold and silver will more than likely respond very favorably in the days ahead. And this is worth talking about. All right, so I want to take a minute, share some thoughts in reference to just some graphs that I think is worth bringing to your attention because whenever you know the banks and there's rumors and there's rumblings of liquidity issues as well as debt saturation, there's an indication that the Federal Reserve will be forced to respond because we all know that this entire system runs upon the idea of the banks remaining healthy because bankers make the world go round in a sense. And so in this video here, I'm going to share with you some graphs that I came across on the internet that I think you should pay attention to because whenever there's a distressed narrative out in the markets, you know that there's going to be liquidity. And based upon what I'm seeing here, there was a nice amount of liquidity injected, and it was just the first round. And based upon history, we know that there's a lot more coming. Therefore, expect gold and silver to respond favorably, and at some point, perhaps even the digital asset space when they're ready. But as always, let's just jump right into these graphs here. Don't want to waste any time, and I want to just try to share my 2 cents and give you something to ponder on throughout the day. So on the screen here, you see the unrealized losses on investment securities. And so literally this chart here tells a lot, and I'll go through it because there's three primary time frames worth mentioning here, because on the graph I'm going to show you in a second, it really expands upon the response to the three issues on this graph here. And so let's just start right off with the very first one. So anytime you see the graphs above my head that are below the zero line, that is an indication that the banks were experiencing some type of financial stress, i.e., liquidity stress. And it all had to do with current events in the market. And so on the screen above me, you see three somewhat larger below zero time frames. One happened to be over here during the great financial crisis. One happened above my head as a result of what led to the health situation that leading into 2020. And then of course you see as of the last 3 years now, in an environment where the Fed hiked rates at an unprecedented amount and time frame. And these are the things that has caused a lot of the banking stress, just due to the fact that these liabilities, as I call them, are underwater, meaning that there's losses that are being taken by the banks. So they're in need of cover up or liquidity to make their wrongs right at the expense, of course, of the taxpayers. And so let me just dive in here. So on the screen, let me zoom in. I want to show you exactly what I'm referring to here because I'm going to show you overlay another graph. And so literally, this is the first issue that we had leading into the GFC. And so the banks were beginning to take losses as a result of the economic conditions of that time frame. And of course, as a result, we went from 2009 all the way up into 2017-ish of QE1, which is like kind of like this first blip. Then QE2 was like this second blip here. And then this phase here was just all the excess liquidity provided by us being in a zero interest rate environment, meaning that they were basically getting cheap currency at zero costs for the most part. And so that was a way of covering up the first GFC issue that the banks were experiencing. And then, of course, the Fed began to tighten. They tightened right into the second event that the banks had. And so as you can see above my head here, this second time it went below zero, that was a time frame where the Fed began tightening. And I think they got through two tightening cycles. I think it was 50 or total about 75 basis points, if I'm not mistaken. And then that was an indication that the banks were experiencing extreme stress. And then long behold, we had a health situation, which happened to be so timely in the fact that it helped save the banks, but then injected a massive amount of liquidity. And so this second tranche of liquidity in between the second drawdown and the current drawdown was the stimmy checks and the everything that came with that. It was 2 or 3 different bills passed under Trump and Biden. So it wasn't like a left-right thing. It was just, to save the system. They just needed liquidity. And so as you see here, it surged to the tune of, was it $6 or $7 trillion created that ultimately flow through the coffers of the banks, whether it's like people depositing their stimmy checks directly into their bank accounts, or the PPP loans, or just a direct injection, or the banks or the the open market committee buying up all that excess of debt that was created by our government and putting it on their balance sheets as an asset. Okay, so lo and behold, here we are now, the primary crisis that is worth touching on. So the banks directly are taking, let me see here, just as of update here, it says, this is from bar chart. Let me zoom out some so you can see what I see here. It says here, the U.S. banks are now sitting on 395 billion in unrealized losses as of Q2 of this year. And so we're now in the process of cutting. But the problem is the Fed can't cut fast enough to help make up some of the losses that the banks are sitting on. And so, right now we're 2 cuts in, and there's going to be a lot more cuts, of course, because, we're clearly in a crisis due to a lack of liquidity. And liquidity is what makes this entire system stay afloat, because you can't ever service the previous debt. You have to create new debt in order to take care of the interest on the current levels of debt, and then be able to fund our future in a sense. And so not only is this government shutdown a part of this, but once again, as I mentioned, everything is centered around the banks. And so the health of the banks is way more important than the average Joe and Jane or the average investor out there, because once again, they made the system, they set the rules. And so with that being the case, those were the 3 charts there that showed the distresses that the banking sector experienced. And each and every time the Federal Reserve stepped in to make sure that they were supported. And so once again, right now, here's another chart that really shows you a much different picture as well. So on the screen here, you see the overnight repurchase agreements, which was a bailout tool created to provide liquidity in an emergency situation for the banks. And so on the screen behind me, it's good to say you have not seen this in this shape and form. And so every blue line on this bar graph shows the excess liquidity that was put into the system to save the banks. And so over here, this was the first blip I showed you on the previous screen of the GFC. So heading into the GFC, there was an incremental amount of liquidity being offered to the banking sector to provide some cushion between the assets they were holding and the amount of losses they were taking with those assets. And I keep doing quotations because, once again, if everything is based upon liquidity, it can't really be an asset if it's always needing more fresh liquidity to keep things profitable for the institution. So literally, debt in and of itself is a liability if it's not being serviced or serviceable, i.e. meaning people not paying loans back, people defaulting, and all the things that come with, a bankrupt system. Because once again, our currency is all debt and digital representations of currency that people, when they sign their names on contracts and loans, that brings fresh currency into the system. But in this case here, we have the central bank directly injecting by simply taking some of the liabilities off the bank's balance sheet and putting it on their own, and then basically buying them things, or giving them liquidity in exchange for those instruments so that they can service some debts and meet some obligations on their end. So literally, it's a bailout for the banks itself. But here we have the great financial crisis over to this side here. And then, of course, as a result of that, when it peaked, when it spiked, when liquidity spiked for the reverse repos, we see that we were in the gray territory, which was a recession. And so literally, we know what all happened from there. And everything above me where there's no signs of blue, that was when the excess liquidity was brought to existence. So there was no need for an emergency situation, because the government did it directly with, QE1, 2, 3, and everything else, the TARP, and you name it. And then, of course, we get to the 2017 timeframe, which you can see over. Let me zoom in some here. Let me try to zoom in if I can. I probably won't be able to zoom in anymore. Let me just click on this so I can zoom in, just to give you a time frame here. So as you can see over here, this blue here is the same. This is the second result of the banking tightness that took place leading into the health situation. So literally during all this time frame here, or more in particular, right in this time frame here, this is when the Fed began, the tightening, i.e. raising interest rates, and therefore the difference between the debt that was issued and the amount it was issued at, and the current environment they were in, were starting to turn negative. Therefore, losses were being taken, and we needed liquidity. And so the health situation happened at the same time that the banks needed liquidity. Not saying there's a correlation, but then again, we know there's no better time to use an event to disguise it as an opportunity to create more manipulation within a system, So just keep that in mind. But as of course, we saw the greatest increase of liquidity to the tune of $100 billion that was being put out to provide liquidity for the banks. And so we went through that whole phase there earlier on, and it was sanctioned by our government because it was what was needed to protect the system. And they disguised it as like, oh, we got to get funds to people, stimmy checks. Okay, cool. And of course, we went through a phase where there was more than enough liquidity. And so the banks were well beyond liquefied for a couple years until we got to the tightening phase. So here we are now, 2022, they began tightening the quantitative tightening phase. And so literally as that began to wind down, here we get into the modern or the most recent blue surges on this chart here, which shows that there's been incremental stress due to a lack of liquidity within the banking sector. And so on the screen here, we just see what appears to be perhaps just four blips of surgence of currency. But then what's most notable is literally last week, you see this big long one over to my left, which is probably your right, which indicates clearly when you get something like that out of nowhere, that's an indication that something broke or something is extremely problematic for the banks. And so who stepped in? The Federal Reserve. And this is why these windows were created in the first place, which was to provide help for the banking sector. And so literally what we're seeing on this chart here is the overnight repurchase agreement, where literally the total securities that are purchased by the Federal Reserve, it's like a quasi loan. But then again, that loan could be open-ended. It could be a short, like 24-hour time frame of a temporary loan, or it could be drawn out to a month or whatever. And so literally as the system experiences, I guess, banking tremors due to a lack of liquidity, these type of windows here were created in emergency situations, and liquidity was provided. And so clearly when we see a surge like that, where you see 30-ish billion dollars being given within a very short time frame window, that is just the first surge of what will be many to come. And so the reason I say first surge is because if you look at previous events on this chart here, every time the blue lines appear, it was just not one or two or three. Over here to the GFC side, it was like every day for several years, there was 10, 15 billion dollars being lent out for emergency sake. And then of course we had the $100 billion day, and then all the other subsequent days that were, as you can see, 23, 50, 60 billion put into the bankers' possession as a result of the stimulus. And each one of those previous two took place within that gray bar time frame, meaning a recession. And so literally what this tells me, what happened last week, is that the banks are in trouble. As always, they've always been that way. But literally this first surge is just one of many to come. And so to me, that is another indicator of how it's going to be hard to hide the idea that we're not in a recession, because the previous two tell us that when all those surges increase of liquidity, it resulted in recessionary type of conditions, meaning the banks taking major losses. So the reason I did this video here is just to highlight to you that that surge on this side that took place just recently is the first of many to come. And so what will happen as a result of this will be the question. And of course, it will show up right here. And it's going to be hard for them to continue to suppress the price of gold and silver, because literally gold and silver sniffed the banking issues out well before now, because on a global scale, every person that's paying attention and realize the mess that our country's in have been preparing for this. Hence the idea of gold and silver both surging week by week to all-time new highs, relatively speaking, putting pressures on the bullion banks to have to come up with all types of ways to manipulate the price and slam the price down, and collaborate with all types of other entities that try to, keep gold and silver from taking off to numbers that, they can't hide anymore. And so literally, to sum all this up, the banks are in major trouble. That first blip of about 30 billion or so being lent out through a repo window is the first, because there's going to be a second, a third, and a fourth. And this could literally be the spark that leads to the kicking off of the restructuring of the banking sector, as I always talk about, because literally we're in a reset now. And it's these banking events on top of the government shutdown issues and the consumer issues that people are experiencing. Then we have all the SNAP issues, and you name it. Come up with your favorite issue that is of interest to you, and it's going to be something our government's going to try to have to pretend to be able to solve, but they can't. And you can only print so much of these before people realize that these might be the problem in of itself. So once again, just taking a minute, sharing my 2 cents. Keep an eye on the banking charts. You won't see it from the mainstream media, of course, so that's why you got to get it from alternative media. And I'm curious to find out down below, have you saw this chart from someone else or someone else out there? And I'd be curious to find out their thoughts on it as well. So feel free to share your favorite commentators or alternative media analysts that talk about subjects like this, because I just scan the surface, give you to you straight, let you know that the reset is here. Nothing that a man in a suit in the White House or anywhere else can't solve these problems, because they're a monetary phenomenon that must take place. And so therefore protect yourself. And of course, you know how to do that. And so for those who might be new, might be coming across for the first time, if you are, then make sure you subscribe. Take this information, share it with people who might be interested on how to protect and preserve everything they work hard for, because the banks will be taken care of at the expense of the user of these things here, because they're going to create trillions of these things real soon, and you don't want to be just holding on to these things. So that's just my 2 cents. But anyway, if you guys found value, hit that thumbs up, drop a comment, and take this, share with family and friends so they can get alternative perspective. That's my job here, just to have you rethink everything, because we're in a position where not much really makes sense anymore. But then again, you know that. So resources, links in the description. Check them out if you guys are interested in diversifying outside the mainstream narrative. But be blessed. Shalom.